This is Shashank Mehta. I'm the founder of Equity Math, a Mumbai-based firm focused only on distribution of SEBI-registered portfolio management services. We are here with Mr. Rajesh Kothari, who is the founder and CIO of AlfAccurate Advisors, also popularly known in the market as AAA PMS. Mr. Rajesh has delivered a staggering 8x return over the last 12 years in his PMS. So your 1 crore has become more than 8 crore, while the market did only a 4x during these 12 years. To me, Rajesh Kothari is the Peter Lynch of India. Welcome, sir. This is a great opportunity for me and a lot of other people who will be viewing this interview. I would want to, first start with how has been your 12-year journey? Any high and low points that you would have experienced with markets. How do you see, yourself 12 years from now, given that 12 years have elapsed?
First of all, thank you, Shashank, for giving us the opportunity to speak on this wonderful platform. As I understand, it's a new venture by you, and I'm sure with your focus and dedication, you have miles to go.
Thank you.
Last 12 years has been a truly, what I would say, very, very satisfactory journey. Our vision is to be the world's most admirable investment advisors. And all along last 12 years, we are fortunate to have support of best of the national distributors, best of the family offices and clients who have entrusted their capital to us. My biggest accomplishment, I would say, is building the very strong, very robust investment culture in the firm.
Okay.
Our central tenet of investment thesis is that a set of disciplined processes, when managed by capable and experienced investment team, it can deliver long-term, sustainable, superior risk-adjusted returns. And our top-notch performance of last year, 12 years, which you spoke about, is a result of that. As far as next 12 years, as few veterans have said, lage raho, correct? And it is all about that. Keep doing the work, what you are doing it consistently, I'm very fortunate we have the best of the team in our firm who are passionate about what they do. And that's what matters. I think it is a journey. And there is not a single journey without such points, correct? The classic example is March 2020, the COVID, the recent one. But it is that discipline process, what we have built in our firm, that becomes very handy. That experience, combined experience of a team of almost 80 to 90 years, that comes very handy, that how to tackle such situations. Not only in terms of stock selection, but also in terms of the building the portfolios and taking the right calls at the right time, in the right proportion, to make sure that, as I said, I keep using that word, risk-adjusted returns. And over next 12 years, as I said, lagero, and let's see where we'll be. I'm sure God has been kind, and with support of so many well-wishers, clients, this is an inflection point for us, and the exponential growth will continue over next 10, 12, 30, 40 years.
For our clients / investors out there, note that this is really important, that while a portfolio manager tries to achieve as high CAGR as he can, it's really important that for every percentage point of performance that he intends to deliver, what is the percentage point of risk that he takes? And that is what, simply means a risk-adjusted performance is really important. So moving on, sir, they say that philosophy is the glue that sticks everything together. If someone were to ask, what is AAA's philosophy when it comes to investment management?
You are absolutely right, Shashank. And as the investment guru, Mr. Warren Buffett says, rule number 1, don't lose money. And rule number 2, never forget rule number 1. We strongly believe in protect capital, create wealth. Wealth creation is important, but what is supreme is how can we protect capital. That's something very, very important. 100 to 50 is a 50% decline. But to reach back to 100 is you need to make 100% recovery.
Right.
And therefore, the risk management is a centric parameter, the centric thesis of our portfolio construction. The protection of capital comes from identification of the risk and then mitigation of those risks. So at AlfAccurate Advisors, our investment philosophy is to reduce such risk. Now, what are the various risk factors? The first important risk is the governance risk. And here I am not talking about standard governance risk, what people talk about, which are easily identifiable by looking at the balance sheet of the companies. I am talking much beyond that. So say for example, number one company globally, Volkswagen Global, and one emission norm scam. There is an erosion in wealth by 40-50%. Or if you look at India's largest pharmaceutical companies, the US FDA import alert. Largest companies, but yet the wealth erosion was huge at the time of announcements of such events. So the question is, can you predict such events? Answer is no, you cannot predict such events. So you have a governance risk, then you have a technology risk. The biggest example is BlackBerry and Nokia's of the world. From blue chip companies to the bankrupt companies. The pace of technology can throw your business out of window. How you mitigate this risk? You cannot predict again. And third is the business cycle risk, and that's something most important. It's the risk probably which is most underestimated, or let me put in another way, that most smart money managers or even HNI investors, they believe that you can predict this risk. But actually, at times you may not be able to predict this risk. Look at the IT cycle. If you would have bought the best of the companies in 1999, and even if you hold for 20 years, those IT companies, if you would have bought in 1999, it generated returns less than fixed income in the country. Why? Not that the companies were bad. Companies were great. Businesses were great. But the growth came down from high 20, 30, 40% to below 20 and then below 10%. So how do you reduce the risk? And that's something very critical. So you reduce the risk by diversification. That's what we do in our flagship PMS strategy, AAA India Opportunity PMS plan. Okay. We diversify across 40-50 companies. We diversify across market cap, large cap, mid cap, small cap. We diversify across 13 to 15 sectors. So that even if you go wrong, because you can't predict, as I said, correct? Even if you go wrong, the damage is lesser. So that is first important thing. Identification of the risk and mitigation of the risk. Second very important thing is discipline exit strategy. Correct? So this is how you try to control the stock specific risk, sector specific risk, market cap specific risk, and of course, most important is of course, and I'm sure we'll get into it as we talk, is about the selecting, of course, the best of the companies. But what is more important, because I think in India, or probably now even the millennials know which are the best companies to buy. The important is what you do once you buy, and that's the balance what we need to do. So we create very, very balanced portfolio. We do not take any extreme bets on a particular sector or a particular company or on a particular theme. It is a well-balanced portfolio that helps you to deliver long-term superior risk-adjusted returns.
Well, I think if I were to also highlight this importance and understand that risk management is essentially at the center of AAA's investment philosophy. And for our clients, / investors who are listening, take this from me. Managing risk means not having a bumpy ride. Risk management is at the center of a PM's philosophy. Your journey of 3, 5, 7, 10 years while he makes your portfolio go a 2x, 3x or a 5x, the drawdown that you see in every market downturn will be far lower than what you see otherwise, and the journey can be much more smooth. So thank you for that, sir. Just a follow-on question, that were there events that shaped up your philosophy? Were there market observations that allowed you to culminate your philosophy into what you just described today? or was it the same from day one?
Well, of course, Shashank, it is a learning curve throughout, and you keep learning. Even today, we are students, and it is market is supreme, and it is better to remain student, and that's something very, very important. But in terms of the risk management, that was the philosophy what we have followed since I would say I'm into equity market. So I'm into market since almost like 1996. So it's almost like 26, 27 years. And during even my fund manager days at DSP BlackRock Mutual Fund, we consistently followed that strategy of diversifying the portfolio across sectors, across companies. And because at the end of the day, we are trustees of our clients' hard-earned money. Good market, everybody likes good returns. But markets are never a linear line. And what is important is how you balance that thing out, because markets will go down as well. And during those bad years, what you deliver, that's equally important, right? So I think throughout my investment career, I've always followed the diversified, portfolio strategy. And at the same time, whenever I get the response that, sir, do you have a conviction portfolio or do you have a 5 stocks portfolio? And not that we didn't see how it works, but if I go by the experience of many managers, and there are so many products now available in the market, historically, at least as on today, forget India, look at even the US market. The best of the diversified fund versus best of the concentrated fund, it has not outperformed. Even if it would have outperformed by maybe only 0.51%. But the moment you then put the risk below that, risk-adjusted returns, then it is not compensating for the risk for which they are taking, And same thing we have observed even in India. Same story, same experience even in India. If you compare across, the products which are available in the country, and there are probably more than 300 plus products across mutual fund and PMS. And if you compare last 10 years data, the outcome is something very similar. So it is a proven strategy that diversification delivers into risk-adjusted returns. And let me also tell you, that doesn't mean that you do not deliver returns, because there is a misconception. Okay, fine, it is a good risk-adjusted return. That means it is a low outperformance. No, as I said, if you look at the best of the product from diversified category, and if you compare it with best of the product in concentrated category, they are almost similar in terms of returns. So by following this strategy, we are not compromising on returns, but we are reducing the risk significantly.
While Mr. Rajesh pointed out that he does not compromise on returns, and yes, he hasn't, because over the last 12 years he's delivered almost a 20% CAGR. I should tell the viewers that it is not easy. It is not a DIY market out there where you can manage a diversified portfolio and still deliver returns in that range. I was also keen that our potential clients / investors know about how AAA goes about structuring the portfolio, and effectively, is there a model portfolio that we follow, or do we manage individual portfolios? How do we really go about this?
Probably we are one of the few firms in the industry who do not believe in model portfolio. There cannot be model portfolio.
Okay.
We buy today what we like today. We do not replicate copy pasting because it doesn't work. Correct? If an investor is coming today, I will buy into that investor's money something what I like based on today's valuations. So of course your next question would be, so does it mean that all clients have different portfolios? Would be your obvious question. The answer is no. And how we do that? So unlike most other products where the new portfolio replicates old portfolio, in our case is exactly opposite. Rather than old coming to new, new goes to old. Let's say for example, client comes today, typically we are staggered as I said, we do not believe in model portfolios. So we do not have any compulsion to invest all your money at one go. So invest over a period of time. It may take 15, 30, 40, 60 days. So say for example, I'm buying a particular stock today in new client portfolio, say 3% if it is a large cap. And if that company is not part of the old client portfolio, then I will say why. It means I need to ask question to my existing companies in old portfolio and get one out which is the least attractive from a risk reward perspective.
Right.
And buy the new one into it. A little bit maybe technical for your viewers to understand this, but that's keep it very simple. Buy today what you like today and implement what you like today across the old client's portfolio, so that your portfolios, whether old or new, they blossom, they never stink. That's the process working.
Wow, very well said. So the portfolios continue to blossom and they don't stink. And just for our viewers, I think what just sir described is essentially a portfolio rebalancing exercise, which a portfolio manager conducts regularly to eventually get the portfolios aligned. So what happens is that majority of the portfolios will have the top 5 companies same with similar weights. So if the top 5 companies or the top 15 companies, or in this case in fact it's probably the top 20 companies, because we are talking about, remember, a 50 plus stock portfolio, the companies which actually see outperformance will pull not just some clients but clients at large. So in fact even the performance that we were referring to earlier, which is a near 20% CAGR over last 12 years, is a weighted average performance. It's an actual performance of all the portfolios put together. Sir, they say that you can never time the market, and yet it is a human desire deep down below. Every time you realize that there is a sectoral tailwind or there is a certain company that you want to buy, there is a inner desire that you want to really time it. So वो बोलते हैं ना सर कि 12:55 की ट्रेन है तो मुझे तो 12:50 को ही चढ़ना है. So how realistic is this desire?
I would use the word fortunately or unfortunately. Market timetable is not fixed like a railway timetable. So in railway, you can still try your best to catch 12:55 train, and you will be 95% of the time. At least in Mumbai-based, people are successful in that.
Yes.
Because I was also traveling by local train. But in market, that timetable is not given. Correct? Nobody knows. As it has been famously said, time in the market is more important than timing the market. You can never time the market. Right? It remains on your paper. If suppose somebody tells you that I bought the stock at the bottom and I sold it at the peak, possible once you go right, possible twice you go right, but you cannot go right every time. Otherwise you become God. So even if suppose somebody claims, it's not possible to believe that. But what is therefore more important is, from the investor's perspective, they should remain in equity as an asset class, because this asset class will continue to deliver significantly superior returns over the long term. Let me tell you one important thing, Shashank, here. Why that urge? Why that desire? You use the word desire to time the market. Because at the back of the mind, investor is a fear that what if market comes down tomorrow? Correct? What if I invest today and I will lose my capital? Am I right or not?
Right.
Do you agree?
Right.
And there is an answer to this. So the question is very valid. What if I lose my capital? And that's hard-earned money, correct? And the answer lies in the investment horizon. If you look at Nifty, forget the stocks, If you look at the Nifty returns, and if you do something called rolling returns, correct? For last 10 years, 20 years, 30 years, since inception, according to the data, it is proven that if your time horizon moment it is more than 6 years, I repeat, if your time horizon is more than 6 years, the loss probability is almost next to zero. So now what you need to answer to your question is, to your mind is, am I investing my money for 1 year or 3 years or 5 years or 10 years. And we always tell our investors that you come to equity market only if you have a 5 to 10 years time horizon. Because 1 year, anything can happen. Market has witnessed historically drawdown of 55% on 1 year. Correct? So that loss of capital is real if your time horizon is only 1 year. But moment if your time horizon is more than 6 years, the probability of loss is zero according to last 25 years data. Now let me give you an analogy. If you are investing into fixed income, what is your time horizon? 10 years?
Yes, long term.
10 years, because only in 10 years you can make money double, and now probably it become much longer because net of tax, fixed deposit can give you 3.5% return. That's it. Here I am asking for only 7 years. And do you know, Shashank, if you have a holding period of minimum 7 years, the minimum Nifty returns are 3.5%. Minimum. I am not using the word maximum. Maximum returns are much higher.
Right.
So it actually much better than fixed income, both on returns as well as on the loss probability moment you have a 7 years time horizon.
So I think the key takeaway was, rather than timing the market, I think we should think about time in the market, and that's really well said. And for our viewers, it's also important to know that rolling returns is one of the most popular parameters to understand what a certain vehicle can deliver minimum or maximum for a given time frame. So you could have rolling returns for 1 year, 3 years, 5 years, and as sir explained, over 7 years. So great insight on the timing bit, sir. But फिर भी there must be something that you must be doing internally. थोड़ा सा सर वो सीक्रेट सॉस मिल जाता जानने के लिए कि what attempts do you do or what precautions do you take when you are trying to see a sector that has got tailwind, and when you're trying to buy a stock, you would be having some levers to pull. If you could throw some light on that.
Yeah, of course. So what I meant in my previous question is that equity as an asset class, one should remain invested. Am I right? Now, within that equity as an asset class, the different sectors and the different businesses have different business cycles. So that's the job of the fund manager, active fund manager. That's what the job of active fund manager is to identify the cycles of those businesses, that whether they are maturing or whether they are in a growth cycle. We track the business cycles of the companies in which we are investing, and if you believe that the business cycle is not going to support the company due to internal or external reasons, then you need to take the diversion. So it is like a voyage, am I right? And you need to navigate your ship depending upon the winds, am I right? Because if you go against it, then definitely there will be disaster. So every business has a cycle, and it is very, very important that you identify that what kind of cycle that business is. There are companies in India which had a golden period from 1990 to 2000, and those companies probably are not even surviving today. Let me give you one example. 75% of Sensex has changed in last 16 years. I'm talking about a Sensex. It means I'm talking about blue chip companies. And I'm saying 2/3. I'm not saying 5%. I'm saying 75% of Sensex has changed in last 16 years.
16 years.
So it is equally important. And that's what the job of a fund manager is. To keep checking it on a regular basis, on a prudent basis. Do not make any bias that, okay, I have this stock and therefore the company is great and the stock is great. May not be, correct? The world is becoming a VUCA. What is VUCA? VUCA is volatility, uncertainty, complexity and ambiguity.
Okay.
And that speed of volatility, the speed of uncertainty, speed of ambiguity, speed of complexity is actually increasing every day. And therefore it is extremely important to keep checking that the companies and the sectors what we own, are they going to witness headwinds or tailwinds? And what is more important is that what is the duration of that headwind? If that headwind is for 1 quarter, it's okay. That's fine. That's okay. It's like a one signal on when you are traveling, correct? But if it is going to be a long pause for 3 years, then definitely it is not good for you. Let me give one example. Say during COVID times, I'm talking about early March 2020, when Europe was started getting impacted by COVID, and India was just about getting the headlines of COVID entering India. We realized that it is an unpredictable thing, and it can be a potential very, very big risk, right? So we reduced our cyclicals exposure. So in a portfolio you have cyclicals and you have defensives, right? And both we follow growth strategy, both have growth, but one is cyclical, one is defensive, correct?
Right.
So we reduced the cyclicals exposure by almost 15 to 20%, and we increased the exposure to pharma sector to almost, I would say, to 15% of the portfolio, from 3 to 4%. And then, of course, during March, the lockdown got announced. The market after that corrected in a big way. But pharma stocks didn't correct. On the contrary, pharma stocks went up by 30, 40, 50, 60% by October 2020. Normally, pharma stocks moves up by 10, 15% in a year because that's how the businesses are. But because of the pandemic, their business flourished, and therefore the stock prices also gave you 50, 60, 70% returns. And the cyclicals, on the contrary, they actually went down or they remained flattish because it is a very bad time for Indian economy. By October 2020, Indian economy witnessed the COVID wave 1, which was very dangerous, and from October it became more like a unlockdown. If you remember, during that time, the unlockdown started. Indian economy started recovering. Pharma stocks already went up 50, 60%. We made big money. So we sold pharma stocks again and came back into the cyclicals where we sold 6 months down the line, because we already got that at a very attractive price point and the risk got reduced. So the rotation is one thing which what I'm trying to say is that you need to keep your eyes and ears open. You need to be prudent in your allocation, and depending upon the growth potential of the portfolio companies, you need to take the right action decisions to ensure again that you keep building resilience with a good margin of safety.
I think this really echoes something that we have been selling to our clients, which is there is no buy and forget, especially in this neo world. There is rather an appoint and forget, appoint a SEBI-registered PM such as AAA and forget, and let the PM decide what to hold, for how long to hold, how to exit, when to exit, and so on. How do you go about shortlisting a company? Because it's like finding a needle in a haystack. It's really difficult to imagine what is really the starting point for a PM to shortlist a company for his portfolio.
While we talked about risk management till this point, but of course wealth creation is something which is of paramount importance, am I right? And we have a very simple and very, very effective our proprietary investment framework, which is called 3M investment approach.
Okay.
Market size, market share, and margin of safety. Market size is size of the opportunity. So we buy that business or a company provided the sector in which company is operating is pretty large. So that if the promoters are good, the business is good, then you can make exponential returns. But it is the second M which is most important, and that's market share. We buy the businesses which are only those companies that enjoy top 3 position in the industry. We buy only leaders. We do not buy challengers. Very important reason is, if you are buying a leader, you may go wrong economic cycle. Like for example, COVID hit you. You could not predict them, right? Economy cycle you may not predict. Industry cycle you may go wrong, which is possible. But if you have bought the leader, then the companies with that leadership character has an ability to navigate upturn and downturn of this industry cycle and or economic cycle.
Okay.
It's much superior and stronger compared to its own peer group. So say for example, the classic example is say NBFCs, which went through IL&FS credit crisis. There are many NBFCs found huge problems, and even today Many of them are yet to come out of that bad phase of credit crisis. But if you have bought the businesses which are top 3 in the country with the best of the underwriting business risk management, then they not only survived that credit crisis, but actually they grew out of that. Similarly, second example is a real estate, which went through the painful times since last 6 years. Because demonetization, then GST, their era, then credit crisis, and then COVID wave 1, and then pandemic wave 2. They got almost a major problem. But it is a difficult time that if you look at the companies which is number 1 in Mumbai, or company which is number 1 in South, they actually gained market share during downtime. And they are further gaining more market share during uptime. So buying the businesses, buying the companies which are leadership position has this unique advantage. In fact, we have identified 30-40 sectors in India or subsectors in India where there are only limited number of players. So basically we are buying the businesses which are like oligopolistic or they are like monopolistic.
Okay.
And when a business enjoys monopoly or when a business enjoys oligopoly, your balance sheet is debt free, leverage is very low, your profitability is very high, and therefore what ultimately matters to us is cash flow is extremely strong. And third aim is nothing but margin of safety. The price is what you pay, value is what you get, and that's of course something very, very important. Buying the businesses at the reasonable valuation, and we are very, very conscious about it. So that's basically the investment framework what we follow. Needless to say that it is just not only this 3M approach, but of course on there is a fence of the best of the governance, the best of the management, and best of the balance sheet. So it is a fence. Under that there is a 3M approach, because governance is something most important, irrespective of how good your business might be or balance sheet. But if the governance is not right, then disaster is waiting for you. So we are very, very clear about it. The balance sheet is also very, very important because capital efficiency is something critical. As a minority shareholder, that's what matters to you. And last but not least is the management focus, the team, the culture, and because ultimately it is a vision. The management needs to have that what I would say strong voice that they may compromise at times in the short term to deliver long-term sustainable performance of the company.
It's the 3M approach ingrained with a tick mark on corporate governance and a capable management who could execute their vision and the plan. So sir, we have understood the 3M approach, but one would imagine that there could be many companies that fit this criteria. What do you really do after this?
Let me put it very, very simple way. So as I said, we have identified 40 to 50 sectors in India where there are only limited number of players. Probably there are sectors where there are only 5 players. Say for example, bearings. In India there are only 3-4 companies. You have a Timken, you have a SKF, you have a Schaeffler. These top 3 companies is actually 70 to 75% of the industry. If you talk about shock absorbers, there are only 3 companies. There are Gabriel, Munjal, Shaw and Endurance, and 1 or 2 might be multinational company, might be unlisted companies. Top 3-4 companies is 92% of the industry. If you are talking about wiring harness, there is only 1 company in India, Motherson Sumi, which is more than 90% market share. If you are talking about credit rating, there are only 3 companies in India, CRISIL, ICRA and CARE. Top 3 is 80% of the industry. If you are talking about a refrigerator, the top 5, they dominate 75% of the industry. If you talk about room air conditioning, the top 5, they control 75% of the industry. In biscuits, there are only 3 companies, ITC, Britannia and Parle. 3 companies is probably 80 to 90% of the industry.
Right.
Correct? What I am trying to say is that when you identify the sectors where there are only limited number of companies, that filter itself is so strong that you have won probably half the battle or more than that. It actually not only helps you for wealth creation, but this approach actually helps you to protect capital also, because these are the market leaders. Let me tell you, they may not be the large caps, There might be mid caps. There might be even small caps, because that is as per the SEBI's definition. What we look at internally, coming to your question, is that we look at internally the profit size rather than market cap size. In India, there are 5,000 listed companies. Out of 5,000 listed companies, there are only 550 companies in India. Only 550 companies in India, which makes 100 crores, which is $15 million of profit. Only 550 companies. Our focus is, our universe is this 550 companies. Okay. That's our minimum benchmark. It's actually very high benchmark. Although you may feel that $15 million is actually a very small number. But to make 100 crore profit, you may require 1,000 to 2,000 crores of revenue. And as I said, in India, there are only 550 companies which have delivered that number. Correct? So, when you buy a company with a minimum 100 crores of profit, it means those companies can navigate the volatility of commodity, volatility of currency, volatility of trade barrier, volatility of geopolitical policies. They can absorb the shock, if any. And as you've seen in the recent times, so much volatility in the last 18 months in supply chain, the inflation, the commodity. But who could survive? Only those who have at least big size to take the shock of such volatility. Right. So that's very important. So in our entire focus list is those companies which have a minimum benchmark net profit with a benchmark market share. So one, you are taking market leader. Second, we are saying it should have a minimum net profit of, say, for example, 100 crores. Okay. Then we said that it should have a low leverage balance sheet. So, for example, if you look at my today's portfolio, all my portfolio companies, almost all my portfolio companies have 100 crores plus profit size. 62% of my portfolio companies have 500 crores plus net profit after tax. When I look at the balance sheet of my portfolio companies, 75% of my portfolio companies have zero debt. No short-term loans, no long-term loans. They have zero debt. Actually, they are net cash. Maybe only 12-13% of the portfolio companies, they would have some debt less than 1 time. So now you think, a portfolio built of 40-50 companies, which are having a profit size of 100 crore, 500 crore, 1,000 crore, 2,000 crores, minimum 100, correct?
Right.
With a balance sheet with a zero leverage or debt equity less than 1 time, how it is possible? It is possible because they all are market leaders. Connecting my dots of 3M approach. Correct. And it is that market leadership with these financials which give them return on net worth of 18 to 20%, much higher than the traditional benchmark indices of 9 to 11%. And it is that character of the business mode which helps them to keep growing the profit by 18-20% compared to, if you look at the Nifty, for example, last 12 years, Nifty earnings growth is 7%. Last 12 years, our portfolio earnings growth is 20%. It is that 20% earnings growth that helped us to deliver 20% compounded returns to our investors. And that is something very, very critical. All our portfolio companies, they are not only best in terms of governance, balance sheet and management, but they are undisputed market leaders, and very importantly, they are into the very strong earnings growth trajectory. And that's critical.
Now that we've understood about the 3M approach, how you manage risk, how you construct the portfolio, how you even shortlist a company and decide when it becomes a portfolio company, how do you decide the holding period? How do you decide when to exit a certain stock? Is it a partial exit or a full exit? How do you take these decisions?
I think very interesting question. As I said, everybody probably knows, or at least they claim that they know what to buy, but people don't know when to sell.
Yes.
And we strongly believe that discipline exit strategy is something very, very critical, not only from the risk management perspective, but also from the returns perspective. Because as I mentioned in your previous question, that 75% of Sensex has changed in the last 16 years. If you look at Dow Jones, there is not a single company today in Dow Jones which was there, when Dow Jones was formed. All have exited. So what is therefore important is, there are 3 things in which we exit. We exit, 1, because of the portfolio rebalancing. So we do not allow weightage of a particular stock or a sector to cross our defined limit. So moment it crosses a particular weightage, then we do auto profit booking. So that is a regular portfolio rebalance. Second, we exit when the valuations are full on a relative basis. So say for example, 2.5 years back, we bought one of the very known pharmaceutical company. The valuation of that pharmaceutical company was 10 times price to earning multiple compared to number one company in India, which was 25 times. And in last 2.5 years or so, stock went up almost 5 times. The valuation of that company, it is a mid-cap pharma company, is now almost equivalent to the number one pharmaceutical company, 25 times. It is no more at 10 times, now it is 25 times, equivalent to the number one company in India in pharmaceutical. So we said probably from here on, everything is good, company is good, management is good, growth is also there, but from here on probably we may not able to make similar returns given the risk of mid-cap. So we decided to exit that company. So exit because we believe the valuations are full on a relative basis. And third, we exit when the underlying growth assumptions change. So if you believe that this company is going to grow, say for example 20% compounded over next 3 years, but maybe due to an internal reason or external reason or government tariff reasons or whatever reasons, that underlying assumptions are going through a change. And if those are changing and it's becoming downward, then you need to exit from the sinking ship, correct? Because either that company will enter into time correction or it will be a price correction, and both are injurious to investors' returns. So that's how basically we implement the exit strategy from the portfolio.
So I think really well put. To safeguard yourself from time correction or price correction, a disciplined exit strategy is equally important. While we've understood, sir, what are the selection criteria, how you go about selecting these companies, is there also a negative list of, let's say, sectors that you avoid or groups that you avoid, a certain type of companies with certain characteristics that you avoid that aligns with your overall philosophy, and you avoid those, that fragment or segment of the market?
Yeah, of course. So, we do not invest into global commodities, which are into, say, oil or metals, the companies like that. The reason is very simple, because we believe that, they have their own volatility. Being commodity, the volatility is very, very high. The tariffs can keep changing on a global basis, and that can change the company's earnings. It makes the underlying earnings very volatile. So we do not invest into commodity stocks. So those are the basically sectors which we avoid. Of course, from the company's perspective, as I said, we avoid all those companies who are challengers. Correct. We avoid, therefore, by default, we avoid all the companies which have a not great management or not great balance sheet. And it is that continuous focus to build companies, only those companies which have a resilient business model, correct? That's what helps us to deliver this return. And during last 12 years, I'm very happy to share with you that we had a 0 accidents in our portfolio. And in last 12 years, even in last 3-4 years, because of the credit crisis, the many banks in the country, NBFCs in the country, the media house in the country, big names in the country, they all were blue chips. But they came under one or other problems and became like a penny stocks. We had a 0 accidents and 0 exposure to such stocks, correct? And some luck, some skill, God has been kind, but our diligent process, our due diligence process is extremely robust. On an average, we meet one company a day, right? So our research team spends a lot of time, in management meetings, the plant visits, and more importantly, the 360-degree due diligence. So it is not only meeting the company, because that's only give the half picture, but meeting the customer, meeting the competitor, meeting the vendor, and getting the views across the value chain. And of course, the experience of different management throughout our career of 75-80 years of combined experience. That's what basically helps us to make sure that we make less mistakes, correct? And keep learning out of it, and make sure that keep buying the businesses which are backed by the best of the managements and with the best of the growth, and that's critical.
0 accidents in 12 years of history is really commendable. I have not come across even professional fund managers who have not met with accidents, having exposure to companies. Sir, we have these different schools of thought. I've come across people who are strong believers of value investing and they keep looking for value stocks. And then there are investors who are willing to pay a premium to buy growth stocks. And then there are ones who are willing to take that risk of taking a turnaround story into their portfolio, and with an event of maybe change in management or some trigger by which they believe that management would be able to turn around that company. So in our flagship product, which is the India Opportunity or AAA IOP as it's known in the market, what is really the mix that you create, or is there a mix at all?
Well, as a house, we strongly believe only in one thing, which is growth. As I said, we breathe growth. Life is all about growth. If there is no growth, there is no life. Correct? Even the value stocks, they perform when the growth comes back into that value stocks. So say for example, very recently, say commodity stocks or utility stocks, they went up because the hope of growth came back into that earnings. Right? So we strongly believe in growth. And of course, that growth you need to buy at a right price, the right valuations. You will never able to buy the best of the management and best of the governance and best of the balance sheet at so-called cheap valuations. And optically cheap is always actually expensive, in my view. And optically expensive is actually cheap in the long term. It's all about your horizon. If I'm buying a company with a compounded earnings growth of 20%, and if I tell you it is a compounded free cash flow growth of 15 to 20%, do you know what and how much valuation I should give to that company? At times, even 50 PE is cheap for that company. Because the free cash flow, underlying free cash flow, what it is throwing, and or underlying the operating cash flow, what that company is throwing is huge. On the contrary, if I give a company which is optically looks like 11 times price to earning multiple, but with a 5% earnings growth, mind you, it is less than 12% nominal GDP growth, actually you are buying that company intrinsically at a much higher valuation than what optically it looks like. Because it is going to underperform even the GDP growth over the next 5 years. Are you getting a point?
Right.
So, never get carried away by just the traditional benchmark of price to earning. What is important is that your time duration. And you are buying the enduring businesses. Correct? In the longer the time horizon and the longer the cycle of that growth, both earnings as well as cash flow, actually makes the so-called optically expensive PE cheap in the long term. So that's how one needs to look at the valuation. So we buy only those businesses which have a solid growth characteristics over next 2, 3, 4, 5 years.
So just a follow-on question on your flagship product, which is AAA IOP, that while I understand that you are cap agnostic when you shortlist a company, but clients or investors generally have a tendency to still understand that what is the cap mix in your portfolio, what percentage would be large cap versus mid and small cap.
Oh, of course. So we are a multi-cap PMS. AAA IOP is a multi-cap PMS, and from the risk management perspective, we have defined minimum 40% will be large cap.
Okay,
that's minimum. At any given point of time, minimum is 40% large cap. Maximum it can go up to 100%. That is as far as the market cap goes. Similarly, there are sectoral limits. Similarly, there are stock specific limits. So for example, from stock perspective, we cannot cross 10%. 10% is the maximum weight what one can go, at the time of the acquisition cost perspective. Yeah.
Okay.
Of course, as I said, we are a diversified portfolio, very well balanced portfolio. So as we speak today, and even in historically, we never had any company which is 9% portfolio, not even actually 7% also. So we are very, very conscious about it to make sure that our market cap weightages, our sectoral limits, our stock limits. If it is a large cap, typically we do not buy more than 3 to 5%.
Okay.
If it is a mid cap or small cap, we do not buy more than 2 to 3%. So we are very, very particular about our weightages, and there are set defined processes and the weightages, so that at the end of the day we deliver superior risk-adjusted returns.
In terms of outlook, while India rallies its way to a $5 trillion economy, since it's only a question of when, because everyone knows it's going to happen. And while India rallies, there is also this disruption that is coming from technology's end, which is fairly rapid. On the one hand, we understand that it's important to be in growth, which is where AAA's focus is. But how do you also safeguard yourself from the technology disruption that could sort of, change your plans?
Wow, I think it's a great question, and I think it makes that VUCA, what I talked about, it accelerates the disruption today. It accelerates that actually VUCA of the business cycle, and therefore to that extent, business cycles becoming more and more shorter. They are becoming shorter every day, and therefore more important is to focus again on not only what to buy but also when to sell. So disruption is accelerating, no doubt about it. But you also need to understand the benefit of disruption and what is causing this disruption. It is the internet ubiquity. It is the democracy of internet, which is resulting into the faster digital economy. And that in turn changes the business models. Correct? So every company, irrespective of how big the company is, they need to be aware about the risk of disruption, because if they do not take the required steps, then these companies can also become the history. Am I right?
Right.
And therefore it is very important to keep in mind the innovation, what your companies in your portfolio are doing. So we have actually very important innovation framework, very detailed innovation framework for each of our portfolio company. And it is just not the disruption. It is more importantly the innovation what you do, so that you do not get disrupted, but rather you disrupt someone. So for example, one of our portfolio company, which is into capital goods company, they have basically implemented world's longest conveyor belt system for largest steel company in Karnataka very recently. It's the world's longest conveyor belt.
Okay.
The entire automation, electrification, implementation was done by one of our portfolio company, which is a MNC company listed in India.
Okay.
So I'm talking about such things. It is just not the digital. And digital is just not about the computers and software. It is much beyond that. It is about the robotics. It is about the artificial intelligence. It is about the process automation. It is about the way in which the consumer behavior is changing and way in which enterprises gets benefit out of it, and so many more things. Correct? So it is very, very important to keep checking that what steps the managements of portfolio companies are taking to keep themselves ahead of the competitors. Because if they do not do that, then their market share may not remain at what they are enjoying today. And now think of it. Who has a muscle to do that? Because you require strong cash flow to do that, am I right?
Yes.
And all of our portfolio companies are
more than 100 crore in net profit.
They are large in profit size, they are market leaders, they are debt free, and they have a strong cash flow. So at least they have an ability to reinvest the cash flow. They have an ability to take chances of innovation, and you may fail in innovation, which is fine. They have a hunger to grow faster, correct? And they have a willingness, and most important is ability. Some other company, number 11 company, number 12 company also might want to do, but they have a debt equity ratio of 3:1. Even if they want to do it, they can't do it. Correct? So our portfolio companies are actually in a very, very sweet spot, and they are constantly innovating themselves in terms of reaching to the clients, in terms of changing their supply chain management, in terms of implementing the best of the softwares, in terms of making the plants automation, in terms of introducing the new technologies for their clients. And that's basically what business mode is all about.
Coming to the last question, and everyone's favorite, what according to you is the market outlook?
Well, I think at times I wonder why people keep asking, what next, correct? One thing is very sure, all macros are in your favor. I think India is a very, very sweet spot. Whether you look at Indian demographics, whether you look at the policy initiatives, the world is looking at India. In fact, in last 18 months, the global companies are looking at China plus one strategy. Yeah. From the government perspective, you have the PLI schemes, you have the Make in India, and many more such initiatives. Corporate balance sheet is deleverage. Banking balance sheet is cleansed up. The NPAs are under control. So we are in the best growth environment. So I think macros are going to remain in your support. Of course, there would be headlines, risk lines, factors like inflation, the Fed policy rate. All this noise will keep coming. But if you have a 5, 6, 7 years view, the macros are in your favor. To be very frank, don't think beyond a point about market. Fine, macros are going to be in your favor, equity markets are going to deliver you, correct? Because if internally, if you ask me, if I keep asking myself, what about market next day? What will be the Nifty next day? What is the Nifty 1 year down the line? There's no point in predicting, am I right?
Right.
Then if I have done that, I would not have been able to buy Dixon, which has become say 5 times from my purchase price, or Balaji MIs, which has become 12 times from my purchase price, or companies like Honeywell or companies like Timken, which has become 5 times, 7 times from my purchase price, correct? Our focus is basically buying the best of the businesses which can keep delivering 18, 20, 15, 18, 20% compounded returns over the long term, correct? Right. And that's where India is a fantastic country. It is a beautiful country with a number of opportunities. We are the best of the entrepreneurs they have a hunger to grow with a very, very, what I would say, disciplined way in terms of the balance sheet, correct? So I think the growth opportunity is going to be huge. Participate in that growth.
If you could give a closing remark and some wiseness that our client and investors need as to how they should approach.
Well, if you ask me, in the recent days, kind of returns what market has delivered has been extremely robust. Am I right? What is one needs to remember is that keep the focus long term. I know everybody's talked about long term and it is a very common thing to talk about, but it's the only patience which pays. Volatility is given. You might have 2 portfolios, trading portfolios and investing portfolios, which is fine. Make sure a trading portfolio is only maybe 5%, 10% of the portfolio, but the investment portfolio, keep your duration, 5 years plus. Because it is only in the long term you can create wealth which is a sustainable and probably which is there for the your next generation.
May I please thank you, sir, for this wonderful opportunity.
Thank you, Shashank. Thank you very much, and I'm sure with your focus and client-centric business model, you will be able to make huge wealth for your clients as well.
Thank you, sir.